Step into one of those massive blue and yellow boxes, grab a couch for $200, and haul it home to build yourself with a little metal wrench and a diagram that never quite makes sense. It looks like IKEA is minting cash off sheer simplicity. Here's the real number. Across 41.5 billion euros in revenue last fiscal year, Ingka Group, the company operating most IKEA locations, held on to only 1.4 billion euros in profit, a slimmer margin than plenty of neighborhood supermarkets run on. Here is what this actually costs. Begin with the physical structure. A standard IKEA location spans 300,000 to 350,000 square feet, and nationwide commercial construction pricing sits between $240 and $870 per square foot, swinging with location and complexity. Even at the cheapest end, a bare-bones store shell can climb into the tens of millions before a single display shelf goes up. When the company built its largest location on record, a 700,000 square foot flagship in the Philippines, it disclosed spending roughly $134 million just to construct, stock, and staff that single site. Factor in land purchase for a lot big enough to hold the building and its parking lot, HVAC and fire suppression systems built for warehouse-sized crowds, and enough inventory to launch with 9,000-plus products, and a single flagship site realistically runs $50 million to well past $150 million before the doors even open, and that's for just one building, out of more than 500 IKEA sites operating across the globe right now. Ingka Group has pledged over $2.2 billion across 3 years, purely to grow its U.S. footprint and delivery network. Genuine capital tied up in bricks and mortar, not a footnote in a shareholder letter. Every operator running an IKEA store, Ingka Group included, hands over 3% of net sales to Inter-IKEA Systems BV, the Dutch company holding the IKEA brand and concept, a toll charged on every euro that comes in before Ingka records a single cent of its own earnings. Underneath that sits the biggest expense of all, cost of goods sold. IKEA's worldwide gross profit landed near 13.9 billion euros, against roughly 45.1 billion in revenue for a recent year, meaning the goods themselves swallowed close to 69% of every sale. Payroll across a workforce that has topped 158,000 people worldwide adds several billion more. Global shipping and distribution, routing flat-pack goods through a network stretching across dozens of manufacturing hubs and 63 sales markets, runs continuously, not as a single startup expense that fades after the ribbon cutting and gets forgotten in year 2. Layered on top of all that, Ingka has actively chosen to squeeze its own margin even thinner. In a recent fiscal year, it poured more than 2.1 billion euros directly into cutting customer prices, a deliberate call that shrinks year-end profit on purpose rather than by accident. Now for the money itself. Ingka Group's latest fiscal year wrapped with 41.5 billion euros in revenue against 1.4 billion euros in net profit, a margin sitting around 3.4%. Put differently, out of every 100 euro rung up at checkout, roughly 96 euros and 60 cents flows straight back out through inventory costs, franchise payments, wages, shipping, and the company's own intentional discounting, leaving under 3.50 as genuine profit. Most people picture a company this massive as a cash machine simply because of its worldwide footprint. In reality, its margin looks closer to a bargain grocery store than a premium furniture brand, and that thin margin is a strategic choice, not a warning sign of a company in trouble. IKEA chose that razor-thin margin on purpose, but a margin that slim leaves almost no room to weather a shock it didn't ask for, and that exact shock has already struck twice within 5 years. The wild card here is global shipping and raw material pricing, and the 2021-2022 stretch proves how quickly it can gut a business, built around shuttling flat boxes across oceans. IKEA Group, the separate entity supplying IKEA retailers, watched pre-tax profit drop 16% to 1.71 billion euros in fiscal 2021 as pandemic-driven container shipping prices spiked to record highs. Fiscal 2022 hit even harder. Profit collapsed 45% to 931 million euros, with IKEA's operating margin sliding from 7% down to just 4%, as material and freight costs kept climbing, and the Russia conflict forced factory shutdowns on top of everything else. Across those 2 years combined, IKEA swallowed roughly 1 billion euros in cost inflation itself, instead of passing the full hit to retailers. The pattern struck again in fiscal 2025, when fresh U.S. tariffs and renewed commodity swings dragged IKEA's operating profit down 26% and net profit down nearly a third, even while the company kept slashing retail prices to hold on to market share. A company operating on a 3 to 4% net margin has almost nothing left to cushion swings of that magnitude, no matter how impressive its total revenue looks in the annual report. To see what happens once a furniture seller runs out of cushion against a shock like that, consider the company that once dominated furniture retail in America. Heilig Myers got its start in 1913 in Goldsboro, North Carolina, founded by 2 Lithuanian immigrants, and over decades of steady growth became the largest publicly traded furniture retailer in the country by the mid-1990s. Running over 1,250 stores at its height, with revenue topping $2 billion by 1998. Unlike IKEA's pay cash and assemble it yourself model, Heilig Myers built its entire operation around lending its own customers money. Roughly 90% of shoppers financed furniture purchases directly through the company, rather than reaching for cash or an outside credit card, making the business as much a small-town lender as a furniture seller. It grew through an acquisition spree, expanding from 647 stores in 1995 to 872 by 1999, swallowing chains like McMahon's Furniture and Chicago's L. Fish faster than it could actually fold them into the operation. As shoppers gradually switched to their own credit cards instead of the company's financing arm, and acquisition debt strained the books, Heilig Myers posted a net loss over $55 million in fiscal 1998, the first sign the growth machine had reversed direction. On August 1, 2000, the company delayed an $18 million interest payment to lenders. Standard & Poor's promptly slashed its credit rating from BB straight down to D, effectively signaling default was already underway. 2 weeks after that, on August 16, 2000, Heilig Myers filed for Chapter 11, announcing 302 store closures and 4,400 job cuts in one move. Every remaining Heilig Myers branded location shut its doors within the following year. This wasn't simply a case of furniture nobody wanted. It was a lending-driven business model built on rapid, debt-financed growth, running headfirst into a retail landscape shifting toward exactly the low-overhead, pay-up-front model that companies like IKEA had been built around from the start. Here's a cost nobody thinks about while marveling at IKEA's rock-bottom prices. The 3% franchise royalty flowing to a separate, privately held company before Ingka's own profit even gets tallied. On 41.5 billion euros in revenue, that 3% slice comes to roughly 1.245 billion euros a year paid to IKEA Systems, a sum nearly matching Ingka's entire 1.4 billion net profit for the same stretch. IKEA Systems is itself owned through a chain of holding entities routed through Luxembourg and ultimately controlled by a Liechtenstein foundation, estimated at $15 billion in assets. Picture the sale from the store floor. An IKEA location rings up €100 in furniture, looking like a clean, profitable exchange to anyone watching the register close. But before Ingka books a single euro of margin on that sale, €3 is already spoken for by the franchisor, on top of roughly €69 in cost of goods, and everything else piled into the Section 2 cost stack. A charge no customer walking out with a flat pack box ever sees, yet large enough by itself to rival the entire retail arm's yearly profit. There's another expense climbing faster than anything else on this list, and it isn't decided by IKEA or its franchisor at all. It's decided by trade policy out of Washington. That risk is tariff exposure, baked into a business model that depends entirely on cross-border manufacturing and shipping. IKEA's flat pack approach relies on producing furniture in a handful of concentrated locations across Europe and Asia and then shipping it efficiently worldwide. A setup that only functions smoothly when cross-border costs remain predictable. In fiscal 2025, new U.S. tariff announcements alone injected enough commodity volatility to cut IKEA's operating profit by 26% for the year, even after prices went up on certain U.S. products, specifically to offset tariff costs. The company has started building domestic manufacturing in response, including a supplier's first American factory turning out bestsellers like the Billy bookcase. But reshoring on that scale takes years and serious capital, not a single quarter to fix. A sufficiently large tariff move against a company's key sourcing countries, stacked on top of an already 3 to 4% margin, is exactly the kind of single event capable of flipping a profitable year into a losing one across an entire industry, not just for one caught-off-guard retailer. Scale delivers real advantages here. A buyer operating at IKEA's size can negotiate raw material and freight contracts no single location rival could ever touch, and spreading fixed logistics costs across hundreds of stores and 915 million yearly visits drives down what it costs to serve each shopper. But scale also magnifies every cost shock in raw dollar terms. A 45% profit swing at IKEA's size is close to €1 billion, nowhere near a rounding error a smaller retailer might absorb by trimming a few weekly hours. Operating across 63 countries also means facing dozens of separate tariff regimes, currency fluctuations, and local rivals simultaneously, any one of which can chip away at the intentionally thin margin IKEA has chosen to operate on. Past a certain scale, IKEA stops functioning like a furniture store and starts functioning like a global manufacturing and logistics operation that happens to sell furniture at the tail end of an enormously complicated chain, where the markup on any single couch matters far less than what happens upstream, out of sight of every customer walking through the showroom floor. Optimistic. One IKEA-scale flagship store pulls in $150 million in yearly revenue. Cost of goods at 69% eats $103.5 million. The 3% franchise fee takes $4.5 million. Payroll, logistics, and operating expenses, modeled at 24% of revenue based on Ingka's blended cost profile, take $36 million. Net profit, about $6 million. A 4% margin, matching the company's own recent real-world results. Realistic. Same store, same year, same crowds walking through the doors. A shipping cost spike, mirroring 2021-2022. Tax 3 percentage points onto cost of goods, matching the margin squeeze IKEA actually reported during that stretch, adding $4.5 million in cost. A fresh tariff on a major sourcing country adds another $2 million in unbudgeted cost on affected products, echoing the 2025 tariff hit. And the company's own strategic call to cut prices and defend market share, exactly as it did in reality during its recent affordability push, shaves another 1.5% off revenue, costing $2.25 million in lost sales. Recalculate. Net profit drops from $6 million to a loss near $2.75 million. On a store that moved the exact same number of couches to the exact same number of shoppers all year, with zero demand shift and zero operational mistake anywhere in the building. The gap between those two outcomes comes down to one shipping spike, one tariff decision, and one pricing call. None of these are rare, exotic disasters. All three actually happened to the real company across recent fiscal years within the last 5. Heilig Myers went from America's largest furniture chain to fully liquidated within roughly 2 years, and it's hardly an outlier. Furniture retail carries one of the steeper failure rates in specialty retail, driven historically by the exact pattern Heilig Myers followed: debt-fueled overexpansion paired with revenue that depended on financing rather than any real drop-off in demand for furniture itself. The documented root cause across the sector is never that people stopped wanting to furnish their homes. That demand has stayed remarkably steady for decades. It's structural. Thin retail margins layered under financing risk, acquisition debt, or in IKEA's case, global shipping and tariff exposure no single company can fully steer around, no matter how carefully it plans. 5 habits separate the survivors from the ones that didn't make it. They steer clear of financing their own sales through in-house credit, keeping the balance sheet free of the exact risk that sank Heilig Myers. They keep manufacturing and logistics in-house, rather than leaning entirely on outside suppliers exposed to identical shocks. They diversify sourcing across multiple countries, so one tariff decision can't hit the entire product lineup at once. They treat price cuts as a deliberate, budgeted strategy rather than a panicked reaction during a downturn. And they grow store count only as fast as real estate and supply chain can genuinely support, instead of buying growth with debt, the way Heilig Myers did throughout the 1990s. That $200 couch sits at the end of a chain where the company that built it kept under 3.5 cents of profit per dollar spent, after a 3% slice already left the building for a separate company before Ingka counted anything at all. IKEA isn't making its money off the couch itself. It's making money by running one of the tightest global supply chains on the planet, well enough to survive on a margin most businesses would call negligible. Thin enough that one rough shipping year or one new tariff, arriving with no warning, can flip the entire year into a loss overnight. Subscribe for the next breakdown in this series.